Hi, I'm Bill Blain, strategist at Shard Capital. In this, our first Lite-Bite of 2022, let me wish everyone a good and prosperous new year. Let's have a quick think about stuff to look out for in this coming year and generally what to avoid. Our starting point is that it's going to be an utterly different year to what we've seen before. In 2021, the everything rally was fueled by easy money, ongoing COVID recovery and mitigation spending programs, and the market's belief that central banks would act to avoid any market instability from derailing very fragile sentiment. And of course, overlying that, we had all the uncertainty about COVID. Was it going to be beaten sooner or later? This year is opening to a very different picture. The COVID picture has changed utterly, and we have a much clearer perspective on how quickly central banks are going to be able to act to address inflation and normalize interest rates. The US Federal Reserve now says 3 or 4 hikes. Central banks are going to normalize rates and unwind the quantitative easing programs that have so juiced markets with liquidity for more than a decade. That's got clear implications for how much longer the bull market can continue. Now, the critical uncertainties are about how destabilizing normalizing interest rates will be. But there's also inflation, whether it's transitory or persistent, and how it develops. And of course, there is the danger that it could morph into stagflation. That's when you get a recession plus inflation. And in some places, that's a very real danger. There are questions about how quickly the global economy is going to be able to put COVID behind it. It may be that Omicron is less dangerous and that economies can reopen, but some countries are fully vaccinated, others are not. Some seem determined to remain lockdowns, others to open up. That's got clear ongoing implications for global supply chains. And of course, we still have massive geopolitical tensions over Ukraine and what might happen between China and the US in terms of Taiwan. These are very much known unknowns, as we call them. But when it comes to getting ready for the coming year, all I can do is go back to that famous boxer who once said something like, "I go into the fight prepared with a plan, which I stick with right up until I get punched hard in the face." And I think that's a pretty good description of what investors are going to have to think hard about in the coming year. The game is clearly changing. The rules that we've taken for granted since 2008, the end of the global financial crisis, have completely altered again. And one aspect that I think is going to change dramatically is the euphoric aspect of market sentiment. That's what's been driving the everything rally, which has fueled speculation to absolutely supercharged irrational levels in many of the meme stocks and crypto coins like Dogecoin that we saw last year. I think that's all going to come crashing down this year, and that's going to cost many retail investors heavily. Sentiment, especially towards some of these tech businesses, is going to change very quickly. Now, I've kind of got what I call my tech valuation stupidity index. Basically, to be brutally honest about it, it's basically what's happening to ARK, Bitcoin, and Tesla. They've all opened this year in negative territory, and to me that is a kind of a proof, a suggestion that people are looking again at the fundamentals. Fundamental analysis, i.e. how much money corporates are making in profits and how likely they're going to continue making profits, is coming back into vogue. Now, on Tesla, I do think Tesla is a proper car company now, and to be fair, Morgan Stanley disagrees with me that they're going to fall in value. Morgan Stanley is predicting a rally to $1,400 on the back of its improving numbers. And that it's already on the final lap of the electric vehicle marathon when every other potential competitor is still trying to tie their shoelaces at the start line. Fundamentally, I disagree. Now, I reckon every car maker could be making decent electric vehicles within just a few years, but they won't be. And to find out why, keep listening. Instead, let me run through some other ideas for the coming year. And the first area that I want to look at is the stock market. Now, inflation is pretty much nailed on for 2022, and perversely, that's better for stocks than other retail classes, but only on a relative basis. The upside for stocks is going to come from higher corporate dividends as the globe recovers from COVID. Sound stocks, which are those that are making decent profits, will continue to beat the risk-adjusted returns you can get on bonds. But it's going to be a very selective market, and distributable profits are going to be very important. And that spells crisis for many firms in the tech sector, which have been spending to become large rather than spending to make profits. Unprofitable firms are going to struggle when it comes to demand in the coming year. In a rising rate environment, which we're going to say, fundamental value stocks are going to outperform, because these are the ones that are going to see their stock price rise and provide dividends. Many of the unprofitable tech companies are not going to be able to do that. And I'm also expecting an ESG backlash. And that's because we've seen energy prices go to record levels because we've underinvested in the fossil fuels that are going to be necessary to transit the global economy to greener renewable power. That takes time. It can't happen overnight. So I predict we're going to see reinvestment back into ESG negative names. Now, if we assume that the global economy does stage a COVID recovery, as I think is going to happen, then I'd expect a knee-jerk Q1 market rally. But this could be the last rally before we see rising rates and lower market liquidity lead to a second half that's pretty quiet for stocks. That's a guess. We can't even call it a prediction. Now, one of the key things to watch this year is going to be consumers. This is not going to be a good year for consumers. They're going to face tax rises, massive increases in their energy bills, inflation of food costs, rising rent and property costs, and even modern necessities like Netflix are going to see subscriptions rise, and all these things will dramatically hit discretionary spending. Wages are likely to remain very sticky for most workers unless they're prepared to move into the more challenging sectors like services, catering, entertainment, and logistics, where wages are rising because nobody wants to do these jobs. Consumers are also going to face debt issues. Exposure to interest-free debt like Klarna is going to be very challenging for many. And if discretionary spending falls, then that's got clear effects on demand through the whole economy. Now, one of the other things I've talked about already is inflation. This year, we can forget transitory inflation. That's very much a 2021 expression. Supply chain bottlenecks triggered inflation, and even though they may be transitory in themselves, they spawn significant consequences. And we're now seeing higher wages in some areas, and supply chains beginning to evolve and change, which has their own inflationary effects. And of course, energy prices are going to remain high for at least the next 2 years as we see energy come back online. Now, for the early part of the year, we're expecting 6-7% inflation rates, which we're currently seeing, are going to remain pretty much online. But that may moderate after we see the COVID recovery and supply chains problems mitigated. So maybe 4% later in the year. But you've got to put that in context. For the last 12 years of bull market rallies in bonds and stocks, inflation was effectively 0 to 2%. Even a rise to 4% is going to have massive, significant consequences on markets. And it's going to take a long time for the economy to adjust and find a new equilibrium at a higher permanent inflation rate. And for markets, that means uncertainty. Now, the bond market is another one that I'm watching carefully this year. The market now expects the Fed could hike 3 or 4 times this year. The Bank of England has already hit the hike button. Rising rates mean a bad year for bonds. But you've also got to remember they're the ultimate safe haven when markets snap. Now, one area that I'd be very interested in is corporate bonds. And I think we're very likely to see a rise and an acceleration in corporate defaults. Now, they've been artificially low since the global financial crisis in 2008 because of ultra-low interest rates. That allows bankrupt companies, zombie companies as we call them, to survive for longer. Unfit companies survive and block the market. They stop the evolution of new companies into their market niches. Now, that means that we've got 12 years of companies that probably should have defaulted but haven't, suddenly facing higher interest rates. And that could get very nasty indeed if we suddenly see a spike in defaults. We also have very poor liquidity in the corporate bond markets, which means that if people do start selling, the market will very quickly set like concrete. Corporate spreads will widen dramatically, accelerating that selling, and we could have a real crisis in corporate bonds. And all the time, people are going to have to be relearning the fundamentals of credit strength, which is basically invest in companies most likely to repay you. Corporate defaults have been artificially low because of low interest rates for over a decade. At some point, we always get mean reversion, and when they rise, it means the corporate bond market could get very messy indeed. Now, one of the other areas that I'm always asked about is cryptocurrencies versus gold. That ain't even a contest. Gold is going to win. I've heard crypto enthusiasts push their argument that Bitcoin is digital gold. I've even heard them argue that gold is more destructive to the environment than Bitcoin. Really? But gold is also real. Bitcoin isn't. Now, one of the major factors that influences gold price are Indian weddings. Whenever a girl gets married in India, she wears lots of gold. And I pretty much guarantee that you won't see millions of Indian girls wearing Bitcoin at their weddings. Let's move on to energy. 2021 demonstrated the dangers of ignoring the fundamental of energy sovereignty. Without it, nations become very vulnerable, as Europe is currently finding out, because it can't import enough gas from Russia. Ensuring sufficient stocks of energy, particularly oil and gas, is going to become paramount in the next few years. Already, Chinese companies have been told to go and secure their energy at any cost. Now, the reason that we've got into this crisis is the rush to green the global economy, which is a good thing, but we've missed the fact that it's going to take time. ESG concerns are likely to be pushed aside as it becomes increasingly clear that the optimal route to net carbon neutrality by 2050, which we all agree is a good thing, depends on a phased approach with gas replacing coal before gas can be replaced itself. The likelihood is for oil and gas prices to remain elevated through 2022 and probably beyond, and again, that's an inflation hiker. And since we're talking about energy, let's talk about renewables for a moment. I'm wondering if 2022 is going to be the year the world wakes up to the fact that wind and solar might be marvelous sources of alternative renewable power, but they won't green the planet on their own. Wind and solar are the least efficient sources of power you can imagine. They're much more expensive than people think to maintain, but they get very easy funding from the market at very tight levels, basically because every single institutional investor on the planet wants to show off to their investors just how green and ESG compliant they are. As long as they're holding renewable assets, they can claim to be green. But the reality is that if we're really going to get to renewable power replacing fossil fuel, we're going to need much more work to widen the range of non-CO2 emitting but difficult energy sources. And that means things like tidal power, nuclear, clean gas technologies. And we also need to be thinking about how we change things like the deforestation of vast swathes of into agricultural land. One of the easiest ways to sequester CO2 will be to reforest, and that has implications for many nations. It is absolutely achievable that we could get to zero carbon by 2050, but it's going to be difficult. I have some predictions in terms of how we get to there, and I do talk about them in my morning porridge commentary, but two that I would mention is nuclear fusion. It's going to remain a tomorrow's solution, even though every year you'll see lots of articles saying it's just around the corner. Nuclear fusion is always tomorrow. And I deliberately haven't mentioned hydrogen in the above analysis because hydrogen is very clean and it is certainly much more efficient than other sources of power, except for, unfortunately, petrol. But it's also far more difficult to actually get in place than people seem to believe. Hydrogen is a very small atom, it's very difficult to contain and transport, and it's not simply a matter of replacing petrol station gas tanks with hydrogen tanks. It's a much more difficult transition than people currently believe. Now, I did say earlier that I was going to talk a little bit about electric vehicles. Electric vehicles, great thing, but in a world where Rivian, the US electric car maker, made 1,400 cars last year, but is worth more than the entire German auto sector, well, that's never really made much sense to me. It makes even less sense when we appreciate that every single electric vehicle on the planet today, and all the ones that are currently in planning, are based on lithium batteries. Now, lithium is a nasty, dirty, dangerous element, and given half a chance, it will kill us all if it leaks into the water table. Whatever Elon Musk is telling us, it's still very difficult to recycle. Now, if we are really going to be making and selling 25 million electric vehicles by 2030, as the current estimates seem to suggest, then we either mine every single atom of lithium that exists on the planet, or we hope that a friendly asteroid comprising of pristine lithium and cobalt makes a very soft landing, as didn't happen in the film that I recommend you all watch, called Don't Look Up. If it doesn't happen, we're going to need a massive rethink on electric vehicle power, and it has to happen soon. Now, fortunately, there are other battery technologies being developed, but they are 5 to 6 years away at the earliest, which means I think it's highly probable that in 2022 we're going to see the rising cost of scarce lithium cause something of a price hike for electric cars, causing their adoption to slow. 2021 saw the fastest adoption of electric vehicles ever, that process will slow as lithium prices rise. Anyway, there you go. A very quick gallop around just some of the market themes I think are going to dominate this year. If you want more, we'll be doing regular light bites on the Shard Capital site, and you can always find out what I'm thinking on the Morning Porridge, www.morningporridge.com. Thank you very much, and I'll talk to you in a few weeks' time.